Hi, I'm Brendan Mills and welcome to episode 10 of Finance Coach TV, you and your business's finance coach. So in the last few episodes, we've looked at the different components which make up a balance sheet, the assets, the liabilities, the equity. Now we want to start using some tools that we can use in our business day to day or month by month to get an assessment of the financial health of our business. So we're going to look at two examples today and use a ratio which is called the liabilities to equity ratio. So liabilities being things that are amounts that we have to pay in the future or imposts that we have owed to other people, other businesses or government agencies, obligations that we need to pay in the future. So we want to have them as low as possible, more often than not. And the other side is the equity, what we're entitled to. So looking at our equity, what we're entitled to, liabilities, what our obligations are to pay other people or businesses. So we're going to look at two examples here. The first example being a company. So this company here has $300,000 worth of liabilities, and we've broken down its equity into the different components, because as we discussed last episode, equity by definition is not necessarily what you see on your business's balance sheet. So let's go through this example. The first one is the share capital, so it's a nominal amount of $10, and like what we discussed last episode, unless you've had an investor come in and purchase part or all of your business, that share capital is going to be a nominal figure, unless we're in those examples of an acquisition. Retained profits, so the profits of the company in previous years, $400,000. Current year profit, so during the current year of trading, we've got $150,000 worth of profit. And the last component is the related party loans, which is a negative, which is why it's in brackets, of $400,000. So pardon me. So what this means is that we have actually, in this company, taken out $400,000 worth of funds for potentially a variety of different reasons, whether they're personal, business, investing, or otherwise. Which means instead of what traditionally we would have in equity is $550,010, I believe we actually have $150,010 in equity compared to $300,000 worth of liabilities. So for every 50 cents in equity we have $1 in liabilities. So just remember that. We'll come back to that ratio in a moment. The next entity we've got here is a trust. So a trust, very similar to a partnership or a sole trader in the nature of its equity. Very different from a legal perspective, but from the perspective of equity, they'll look very similar. So in this trust, we've got $400,000 worth of liabilities. We have a settled sum of $10, so that's the equivalent of the issued capital for the trust. Current year profit of $300,000. And the next part, related party loans. So I put an asterisk next to that for a reason. Related party loans of $500,000. So as we discussed in the last episode, a trust or a partnership or a sole trader can't retain its profits for legal reasons. But it distributes those profits to its beneficiaries, partners, or otherwise at the conclusion of each year. That doesn't necessarily mean, though, that they take that cash out of the business. So what we're saying here is this trust actually owes related parties $500,000. So I believe that's the equivalent of retained profits. The owners or the beneficiaries of the trust have decided to keep that money within the trust. So they've retained those profits. So traditionally, this equity of this business would be $300,010. I actually believe it's $800,010. So for every dollar of liabilities, we actually have $2 worth of equity. So again, vastly different to the company example where we had 50 cents of equity for every dollar of liabilities. So what's the significance of that to you and your business? Well, like I said at the start, it's a reflection on how much you owe compared to how much you're entitled. Now, liabilities aren't necessarily a bad thing, but again, it depends on what you like as an individual. My risk appetite personally as an individual is quite low. I prefer to have more equity or build up my equity in comparison to my liabilities. Having a high amount of liabilities, or leverage as it's often referred to, can help you fast track your growth. So during good economic times, actually leverage and liabilities is a good thing because it helps you grow quicker and gain greater profitability, greater returns. The problem is though, when the economy turns downwards or your market changes in a negative direction, that'll actually have a far quicker negative impact on your business, and that's why you see a lot of business people who fly as high as a kite and then fall to the ground just as quickly. It's because they've been funded by liabilities rather than equity. So that's the first component. Just be wary of what's going on in the market, and also you personally. What do you feel comfortable with? You're the one that needs to sleep at night, so having a good understanding of what, I suppose, your risk appetite is. And it's really important that you measure and understand that. So before I mentioned the trust has $2 of equity to every dollar of liabilities. The company has 50 cents of equity to every dollar of liabilities. So is that good, bad, or otherwise for those entities? Well, if you have 50 cents of equity to every dollar of liabilities or below, you're in what I'd consider a high risk type area. So you need to be really prudent with your liabilities and what goes on in your business. If you're getting profits, yes, that's great, but also remember it can turn around just as quickly and can kill your business. So I'd look at ways to pay down those liabilities and increase your equity. If you've got between 50 cents of equity to every dollar of liabilities through to $1.50 of equity for every dollar of liabilities, you're in what I'd consider the okay region. You just need to keep an eye on it. You don't necessarily need to do anything drastic at that point in time, but you just really need to be careful of it and constantly monitoring it. If you've got greater than $1.50 equity to liabilities, you're in blue skies at the moment. So you're doing a good job of keeping your equity down. So for example, like this trust, they would be in that area, having $2 of equity to every dollar of liabilities. So what are the key things for you to take away from today? Well, the first thing is to go and apply it in your business and just see where you're at. So getting a fair reflection of what's going on in your business and seeing, hey, I'm here, or geez, I'm down here, I need to pay down some liabilities. So get an understanding of that and build a strategy to get to where you want to go. Because again, some businesses are naturally going to have lower rates than others because of the nature of their business. But it's really important to understand where you're at and then take action as a result. Hope you enjoyed today's episode and look forward to speaking to you soon.